The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Is there such a thing as a rebound record rally? Live from Studio 2 at Bloomberg headquarters here in New York, I'm Romaine Bostick. We're kicking you off to The Close here on this Wednesday afternoon. A closer look at an S&P 500 trying to push for a fifth straight day of gains to a second straight day of record highs. But unlike yesterday, as you can see there on your screen, yesterday was powered by big tech by a factor of about 2 to 1. Kind of absent today with a softer push higher coming from materials, healthcare, and industrial stocks. You did have some strong earnings out of Eli Lilly and Amgen, some encouraging guidance coming out of Emerson Electric, and a glimmer of progress with regards to the situation in Iran, and that's helping to lift a lot of the precious metals miners like Newman. All that, though, just barely enough to blunt the impact, the big drag that we continue to see from some of those big tech names on the day, like AMD and like SpaceX. And that is the kickoff to the show today. For almost 2 months now, the bulls had tried to break the S&P out of its narrow trading pattern, and they finally did succeed earlier this week with the S&P notching its first record high in 10 weeks. But as the ancient Romans knew, all glory is fleeting, and most strategists, they see a low ceiling to this rally as the wanton risk and appetite wanes and fundamental analysis, that actually comes back into vogue. And that is kind of an auspicious, well, depending on your mood, maybe an opportunistic setup into earnings tonight for memory chip maker SanDisk, which will be accompanied by the company it was spun out of last year, storage device maker Western Digital. Two of the best performing stocks in the first 6 months of the year, taking a beating in July as investors started to question valuation and tried to time out just when this once-in-a-lifetime bottleneck in computer chip cycle might actually finally start to ease.
Where are the bottlenecks? Where aren't the bottlenecks? What the market is constantly grappling with is, a bottleneck only exists till new supply comes on. So that's where some of the volatility is, below the level of the hyperscalers and the core players.
Now, last month, 47% sell-off in SanDisk and 15% sell-off in WD, also exacerbated by chaos at the AI-focused hedge fund Situational Awareness, which lost 67% that month and, had to sell back the bulk of its public stock portfolio to Ken Griffin's Citadel to meet those margin calls. And that takes a look here, and you can see they're not actually alone in that. A lot of hay being made out of the high leverage that the company had made. A lot of hay, of course, being made out of, the youth of its leader. But as some of the monthly numbers from some of these hedge funds do start to roll in, you see that what happened last month was not a one-off when it comes to what happened out there for Situational Awareness. Cotu, and actually one of his big stock-picking funds, down significantly in the most recent month, 0.72. As a whole, down about 3.3%. Its Turin stock-picking fund down even more. Millennium dropping about 2%. Valiancy and Verition also moving lower by about 1% or 2% in the month. Joining us right now to kick us off to the close is Mithra Warrior, Managing Director and Global Head of Financing Sales over at Scotiabank. Mithra, great to see you again.
Thank you. Great to see you.
So I do have to ask you kind of what you're seeing behind the scenes. We had kind of had this big, I don't know if we call it a washout, but certainly a shakeup last month. And we saw a lot of deleveraging, particularly by the hedge funds. Obviously, there were margin calls for some folks that we know of now publicly. Are you seeing a lot of those folks now on the sidelines, or was it just kind of we went through a few weeks, things kind of got washed out, and people are coming back? Or what are you seeing?
So the headlines last week are an indication of just the significance of the AI trade and the dominance of AI to hedge fund and broader market returns, but also the risks of concentration, volatility, and leverage. But the reality is the broader hedge fund industry, if you look at the significant portion of the top 10 hedge funds, where the AUM growth has been, it's been in global, diversified, hedged portfolios with fairly little correlation to broader markets. So painting what happened last week with a broad swath as relating to the overall hedge fund industry is not exactly fair. And while we have seen some returns come in that they've been down last month, it's still overall up on the year is what we're seeing. And as more returns come in, we do think that will stabilize.
Well, I'm curious, so you think it's kind of a mischaracterization with regards to, I guess, the outsized nature of what the AI trade is. And you're saying that basically it's a lot broader, a little bit more diversified than maybe what we're making of it.
Yeah, the $5 trillion trillion plus of assets under management in the hedge fund industry consist of multi-strategy funds where they're by nature diversified across strategies, across geographies, and across directionality. You have global macro funds, you have event-driven players. So sector specialists, especially directional sector specialists, they tend to dominate the headlines, especially in sectors and themes like AI.
Well, I am curious, particularly with some of those multi-strat funds. I mean, they are kind of punching above their weight, at least historically, when it comes to assets under management and to a certain extent performance. I mean, we showed on the screen the multi-strat funds, while some of them were down, they were still outperforming some of the more concentrated stock-picking funds. Was there a sort of a deleveraging and degrossing, though, at all that occurred with some of the multi-strats?
So part of the reason that they do present a diversification alternative for investors and they're so liquid is that they have the ability to degross. They can cut risk, and risk management is actually at the core of multi-strategy hedge funds operations and its value proposition to hedge funds. So they have the ability to have very tight risk limits and react quickly when there are corrections in the market.
Are people meaningfully short this market at all from what you're seeing on your side?
We're seeing activity on both sides, frankly. AI will continue to be a dominant theme, and we'll continue to see both short interests as well as long positions. Adding to that is obviously the IPO market. We're seeing a very active M&A environment as well. So all these contribute to a lot of flow and activity and volume that we're continuing to see on both sides.
Have you, and with regards to just kind of margin risk and obviously just margin terms, are Scotiabank, are you tightening those terms over there at all?
I would say across the market, post-GFC, post-Archegos, risk management across banks and hedge funds has really continued to evolve, where there's robust communication, technology has gotten better, your ability to monitor risk, manage, and react has all gotten faster. As we did see last week, there were margin calls, but at the end of the day, liquidation was still orderly, and we avoided a major calamity. So I do think as an environment within the prime brokerage space, within the hedge fund space, we feel that there is adequate risk management, there's appropriate monitoring, and everyone continues to learn lessons from each incident that happens. That makes us all better.
Well, speaking of lessons, I do want to get your thoughts on what we learned from the Fed over the last week and a half. I mean, last week, a week ago today, obviously you had a pretty visceral reaction in the Treasury market and secondary market with regards to the communication on the Fed's fight against inflation. That's subsided, obviously, a little bit, though that seems to be more a function of what's going on in the Strait of Hormuz and elsewhere. Is the yield story, the Treasury story, going to be a big part of the story with regards to how people are positioned going for cross asset-wise?
Yeah, I think it does show up. Certainly sectors that are impacted by interest rates are going to be relevant, and we're going to see flows both on long and short side across from it. But that's why global macro hedge funds actually continue to attract investor capital and continue to do well this year, because their ability to play across yields and across markets and also in currency markets is becoming very relevant. So there is actually more of a story beyond just the AI trade, although that's the dominant theme. But you have the Fed, you have the IPO market, and you have currencies that are all in play.
And you think with an IPO market, I know we obviously got a big test with SpaceX a couple of months ago. Everyone's still waiting to see some of the other ones. But once you get past the big mega ones, the Anthropics and SpaceXs and whoever else might actually come out, there's a whole pipeline out there of folks that most people think are going to come to market probably in the fall once people get back from their summer breaks. How does that change the complexion of the market?
So I think what you are seeing is for the first time in a long time, you're seeing the IPO market, but also secondaries, follow-ons, and the M&A market continue to be active. So event-driven funds are actually having a very busy time, and we're seeing that's another area of the hedge fund ecosystem where we're seeing capital and allocator interest flow, and I think that will just continue. The
volatility that we've seen, we've talked a lot on this show about how hedge funds have kind of come back into vogue as of late, and partly because of the volatility and the demand for, I guess a little bit more selectiveness in picking things. Do you anticipate this volatility that we've seen to remain in the market? And if so, is that sort of a tailwind for, if not the performance, certainly the assets and the attention to hedge funds?
I think the value proposition of a hedge fund is to be uncorrelated to whatever volatility is happening in the marketplace. So in an environment where there is volatility, the differentiation among the funds will be their ability to take advantage of it, trade around it, and risk manage through it. So regardless of what volatility is in the environment, you use a hedge fund allocation in your portfolio as a diversifier from your core, your long only, or your fixed income portfolio.
All right, Mithra, great to see you again.
Great, thank you to be here.
Mithra Warrior, Managing Director and Global Head of Financing Sales over at Scotiabank, kicking us off to the close here on this Wednesday afternoon. When we come back, a closer look at the streaming business over at Disney. It was the stars of the show. We're going to catch up with former NBC, Universal, and Sundance executive Evan Shapiro to get his thoughts on where things might go next. Plus, the attention economy to AI and beyond. We're going to assess the rising scrutiny around that trade and what's next for quantum computing. Victor Peng, the CEO over at PsiQuantum and former AMD president, joins us in just a second. And of course, we do get more earnings after the bell from SanDisk and Western Digital. We'll have a full breakdown of everything they report as soon as they say it, right here on The Close, right here on Bloomberg. Keeping an eye on shares of Disney right now, up about 3.5%. This after a strong quarter fueled in large part by the company's streaming business. In fact, Disney says it's on track to spend $24 billion on content this year, also inking a deal with TikTok. Joining us right now to talk all about this is Evan Shapiro, former head of NBC Universal's streaming service and former president of IFC TV and the Sundance Channel as well. The entertainment division did well, 64% jump in profit in the most recent quarter. And there was a lot of talk about not only the amount that it added with regards to the number of subscribers, but its ability, Evan, to continue to monetize it. In fact, I mean, Josh D'Amaro said it on the call. He wants to put Disney Plus as the face of this company overall. You think that's the right decision?
Yeah, I think that makes a lot of sense. You're seeing a lot of big companies, not just in media, but outside of media and tech, going to the super app concept. And Disney has more intellectual property than any other company on the face of the earth, and probably the best intellectual property library on the planet Earth. So it makes a lot of sense to make Disney Plus the face. What's interesting is that their streaming profits doubled. And that's really why their stock is going up right now. And it's why the entertainment division the growth was so spectacular in this last quarter. And so I think there's good reason now that they have Hulu fully in there, they have the Fubo deal in place. And then with this TikTok deal, as we discussed last time when we talked about Netflix, the verticalization of these platforms allows them to compete directly with some of these social media platforms as well.
Well, talk to me a little bit about that TikTok deal. I have to admit, when I saw that story, I kind of scratched my head and I thought, okay, is this going to be one of these where, you know, the old man, you know, goes into the room full of teenagers and says, you know, hello, fellow kids. I mean, what's the strategy here? Is there going to be real symbiosis in the way that they're, sharing that content on TikTok, but more importantly, the way that the users will engage with it on TikTok, and does that actually translate into new subscribers and new viewers and engagement with Disney itself?
So crucially, this is an integration of TikTok into Disney Plus. It's called Verts. So this is not necessarily a TikTok play as much as it is TikTok coming into and being integrated into the Disney Plus environment and curating particular creators reacting very often to Disney content. And when you go on TikTok and Instagram and Shorts, you'll see some of the most popular content on there is creators reacting to, frankly, Disney content. Star Wars, Marvel, Pixar, etc. And this, recent Toy Story is a really good example of that. Most importantly, this allows them to compete outside of the home with TikTok and Instagram and Shorts in vertical, where most video consumption takes place. And then secondarily, this really leans into Disney's strength in ad sales because they're going to package this inventory, this curated creator-based inventory across both TikTok and Disney Plus. So you'll be able to buy the whole package. I think that's going to be very attractive to the creators. They get to be associated with Disney, something a lot of them would like. And B, the advertisers in particular who want that youth culture. And this gives them the best of both worlds, a curated feed and Disney Plus TikTok.
Well, I have two questions on it. The first is, do you think that Disney will stand by this? And by that, I mean, once you start allowing creators in the door, there's always going to be that risk that somebody creates something that is either not safe for work or just doesn't quite fit the family-friendly standard that Disney tries to convey. And we've seen them go down this road before and kind of pull content because they got a little spooked because somebody, let's just say, got a little too creative with some of their properties.
Yeah, I don't think that's a real risk here. I think they're mitigating that risk by curating the feed with TikTok to make sure everything's safe for work and kids, crucially. This is a kids environment in large part. So I think there's protection there. It's also a different age now. You see Mr. Beast on Amazon. You see Ms. Rachel on Netflix crushing it on Netflix. And they see that creator crossover working incredibly well on other platforms. Tubi is absolutely crushing it with their creator strategy. Disney's been late to the game, but because they're Disney, as they did with streaming, they have the capability of coming into a market and into a segment and really being dominant there. So no, I think this is a forever forward, not just for Disney, but all mainstream media, as the creator economy and mainstream media really merge into something new.
I'm curious about the ad sales side of this business. I mean, I know they don't disclose actual subscriber figures anymore for the streaming service, but yet revenue was still up 15%. But then I saw that ad sales were only up 3%. That seems like an interesting disparity. Am I making too much of that?
No, you're not. That's a very good thing. They're also not necessarily breaking out a lot of the particulars in the linear business anymore either. The linear business is sunsetting quickly. And so it's declining much more quickly than the streaming business can catch up. And so they're really doing quite well in advertising, considering how many subscribers are being shed from the pay TV ecosystem week after week, month after month, and how broadcast continues to fall like a hot knife through butter. Conversely, they are doing quite well. Probably the best performing streaming ad sales platform in Hulu. And they're beginning to see that success on Disney+. But they really need to ramp that up on streaming if they're going to overtake the decline on linear. Just a couple of quick points here. First and foremost, sports is really the big bleed here. So sports had a negative operating income growth of 17% and a revenue growth of just 4%. Meanwhile, their rights costs have skyrocketed, right? But they had record years with their basketball coverage and their hockey coverage. The question is, can they convert ESPN into a streaming business quickly enough to make up for the loss that they're getting in subscriber revenue and in advertising revenue from the linear and traditional television ecosystem?
All right, Evan, got to leave it there. And yeah, they did talk a lot about that there on the call. I mean, obviously the idea, they're saying this is just a timing issue when it comes to the sports business, but that remains to be seen. Evan, we'll catch up again soon, I'm sure. Evan Shapiro, their former head of NBC Universal's streaming service, and he runs a fantastic blog tracking the media ecosystem. When we come back, we're going to take a closer look at shares of SpaceX down after its earnings. That's coming up next on The Close, right here on Bloomberg. Time now for our top calls. The big movers on the back of analyst recommendations. We start off with Best Buy, a downgrade over at Jefferies on the back of difficult comps in the upcoming quarters. The analyst trimming the price target just a bit here, saying rising laptop prices from the memory shortage will make it hard for the retailer to maintain its EPS growth above 5%. Next, Elf Beauty, Bernstein upgrading the cosmetics company to outperform ahead of its earnings that's coming after the bell tonight. The firm nearly doubling its price target to $113, though the share is down about 0.5% on the day. And finally, let's take a look at Kratos, the defense contractor. Piper Sandler upgrading to overweight after the company beat earnings yesterday. The firm saying it now has more comfort on the company's near-term growth prospects. Those shares up 7.5%. Those are our top calls, and we want to stay in the defense and aerospace space and bring in Sheila Kahyaoglu over at Jefferies to talk a little bit more about what she's been keeping her eye on. And I bring up Kratos. I mean, defense tech has been hot. When you take a look at Kratos and its peers, are you relatively bullish on what you're seeing there?
In select areas. We actually just upgraded Kratos a few months ago. We were still a little too early, but the stock has essentially halved from 120 to 50. So it's finally displaying some, opportunity in terms of growth. We are forecasting this company to grow mid-teens, and they're profitable. And that's maybe one thing that's standing out with all the space mania and the space hype, is as these IPOs have come into market in the defense tech arena, companies like LHX or Kratos are trying to say, listen, we're already growing mid-teens. We're actually profitable, so you don't have to wait for us to get profitable. And so that's a distinction, as a lot of the IPOs are down 20% in the last month off of the hype that's happened in the defense tech sector.
Well, that's what I'm curious. How do you sort of look at these sort of newer defense companies relative to kind of the old guard, the standards, the RTXs and Northrops and Lockheeds and Boeing in that defense space? Is there room for everybody?
I think so. I actually got positive for the first time ever in the 14 years I've covered the space in June on the larger defense primes. So I upgraded Raytheon and General Dynamics. First time I've essentially had buys on those names for a very long period of time. And the point was that I think defense prime growth is finally going to re-accelerate. These things have grown at 5%, no operating leverage whatsoever, and their free cash flow hasn't really been used productively. And so I think that's changing a little bit. You look at Raytheon Defense, I think it grew 18% this quarter. Amazing results. Margins hit all-time highs. Same thing with General Dynamics. Great growth. And so you're finally seeing some of these names actually grow and benefit from what we've seen in the budget. So all players are growing. You have all these small players growing mid-teens to 30, 40%. So you're seeing a lot of defense growth. It's not only driven by the U.S. budget, it's driven by international budgets and NATO as well. So a big theme here, and we're trying to focus in on the names that have the nearest term upside, both in terms of revenues, but in terms of profitability focus as well.
Let's talk about the commercial side of the aerospace space. We heard from Boeing. They finally got the certification for the 737 MAX, finally. You know, it's like that came out actually before GTA. Give me a sense here, though, of how accretive this is going to be. I mean, I know that these are long-term contracts. This isn't like, you know, they just get some windfall all at once here. But that has to be a pretty big sigh of relief for investors.
Yes, but the MAX 7 is relatively small. It's only customers, essentially Southwest Airlines, and they'll use it on like more niche routes, like let's say Hawaiian Islands. But it's a great step in terms of what the FAA and Boeing are working towards. Like years ago, and for years, Boeing's been plagued by their issues and their relationship with the FAA. So we see, you know, the MAX 7, which was slated to be in August a few months ago, so it's great to actually see it approved on schedule. The MAX 10, which is a bigger variant of the 8 and 9, which is what they're basically delivering right now, probably at the end of the year, and then they'll both enter service in 2027. And of course, the 777X, that's their big wide-body aircraft, that's slated to enter service next year. And that's very important because it's burning $4 billion of cash for them right now. So it's a big cash burn, so they need to get that certified.
What are your thoughts, though, on competition in between the two big plane makers, Boeing and Airbus? There's been a little bit of hay made about the European Investment Bank loan that Airbus got, or line of credit, I should say, that they got, and whether we're going back to what we saw a couple decades ago when we had all these fights over what's a subsidy, what's not a subsidy, everything else. Does that become an issue, or is that just something investors can look through?
I may go off on a tangent here for a second, because I was in China yesterday, as I mentioned, and I just thought about like how great the U.S. aerospace industry is, because it doesn't necessarily need protectionism. It's only Airbus and it's only Boeing manufacturing aircraft. So right now they have such a great global duopoly that they could take advantage of and should take advantage of, given the backlogs are 7 years long. But Airbus is not a great player when it comes to the wide bodies. They tend to discount the A350s, so that takes away some of the upside for Boeing. But in general, a great duopoly to be a part of. No new plans or technology till 2040. So I think these two manufacturers have a lot of earnings runway that they should both be rational players in. All
right, Sheila, always great to have you. One of the best in the business, Sheila Kahyaoglu, Jefferies Senior Aerospace and Defense Equity Research Analyst. We'll be back in a moment. This is Bloomberg. 2 years ago, you laid out a relatively ambitious target that we would actually see quantum advantage using IBM hardware by the end of 2026. We're halfway through the year. Are we going to get that?
Absolutely. If I look at what some of our partners like the Cleveland Clinic are getting done, what the national labs like Oak Ridge are getting done, I can already see the early signs of what they're getting, the progress they've made.
That was Arvind Krishna, the CEO of IBM, telling me back in June about the opportunity and what a lot of people think might be the next big breakthrough technology, quantum computing. For now, next-gen quantum companies are largely in the private space, with our next guest firm building what it calls the world's first useful quantum computer, set to be completed as soon as 2027. Joining us live right now is the CEO of PsiQuantum, Victor Peng. He's also a board member at Microchip Technologies and former president over at AMD. Great to have you here, Victor. I mean, I'm absolutely fascinated by this because I feel like it was decades ago when I was in college. I can remember, professors kind of theorizing about all these sort of mind-bending mechanics of what quantum physics could actually be. And then when you talk to people like Arvind Krishna, and I assume people like you, the folks over at Google and a lot of D-Wave and a lot of other companies, they're basically saying the future is now. Is it really now? Are we almost there, Victor?
Yeah, so first of all, thanks for having me. It's great to be here. And look, I'm in my 5th decade of computing and semiconductors, and it is a tremendously exciting time, exactly because I think we really are very close to the first genuine, unique form of computing that we've seen. So yes, I think the answer is we are very close to that. We're building a fault-tolerant utility-scale quantum computer, which, as you say, what that really means is that we could solve real-world problems. So I think, we are very close to that, and it's super exciting to be part of that.
Well, kind of explain what that means. I mean, I mentioned D-Wave. I mean, they had a computer like more than a decade ago. I know IBM, Alphabet, Google, Amazon, a bunch of other places have already created something to a certain degree. What does useful actually mean in layman's terms?
Yeah, look, I think this is what it fundamentally means is you could solve real problems that have impact, right? That solve, problems in pharmaceuticals, problems in material science, energy, and so forth. And, the technical part of it is you need fault tolerance in order to achieve that. And you need a certain level of scale in order to solve those real world problems, not just in a small scale, solve a problem that you could point to in one case, but really solve, multiple of these important applications that have real economic and societal value. And I think maybe one unique thing about PsiQuantum is since our founding 10 years ago, we've been laser focused on that, right? Not building, these earlier demos that don't scale, but our founders had the vision and we're executing that vision of from the very beginning, developing things to solve real world problems, which means having a computer that's scaled out and leveraging technologies and tremendous trillions of dollars investment in mass manufacturing of silicon photonics in our case, as well as using things like fiber optics, right, to distribute and network these things. We've had that vision from the very beginning, and I think the rest of the industry is starting to come around to some of this. Yeah. But I think that's what makes us a little bit unique.
Well, yeah, and we talk about your founders, Jeremy O'Brien, Terry Rudolph, Mark Thompson, a couple others here. I mean, they brought you in to kind of take this from being just a sort of a research-led company to actually being...
as well.
Thank you. I don't want to shortchange anyone. But to make this into an industrial-scale computing business. I know just from news reports, you were trying to get your site up in Australia operational by 2027. And I know you were also working on something, if I remember correctly, in Chicago as well. How close are these facilities to actually coming online?
Yeah, so that's the other thing. If you have to build something at scale, right, you need to build the infrastructure in those sites that you just mentioned. So in Australia, we're building a site. We just had a groundbreaking just last month. In Chicago, we had groundbreaking in the fall, and they've been doing a fantastic job. We're the anchor tenant at the Illinois Quantum Computing and Microelectronics Park. And so we're building a system scaled out there. And, those dates that you're talking about is when those sites are developed because, we have to develop what's called cryo infrastructure. So this cooling kind of technology to enable you to have your quantum computer, and then we'll be populating that with the machine that, as we said, is going to be at such a scale to really solve real world problems.
Can you give me any sense here of which one of those sites gets up and running first?
So I think, we'll have, some of our machines running in the Illinois IQMP. And then shortly after that, the Brisbane site will be up and operational. And, that's when you're really going to see us solving those problems that I talked about, diverse from everything from, drug discovery, healthcare, materials, new battery technology, solving optimization problems for things like logistics, also optimization problems like portfolio management. So very broad set of applications. And, that's what it means to be at scale to solve those real world problems.
How much more money do you need to get this done? I mean, I know you've raised a bunch of money, including from the U.S. government, private investors, the Australian government as well. I mean, what are we talking? I mean, every day on this program, we're talking about a hyperscaler just trying to build a basic data center that's, basically splashing tens of billions of dollars towards it.
Yeah, no, I think that we have to be careful not to, confuse us with AI data centers. It's a regional facility. It does need the cooling that I mentioned, which is a little bit unique, but it's a much more scaled down kind of capability. We do need capital because we are building those sites, and we've been laser focused on being able to scale up so we can solve real problems, that people can get value from. But it's not to the level of what you see with AI data centers. I think another thing that's really important that differentiates us is the capabilities that we have developed on the way to building the computer that can also be leveraged to, other parts of traditional computing. Like our modality, which is just like, what's our form of qubits, is based on photons, like particles of light. And it just, as you may know from some of your other guests and interviews and technologies, the traditional data center is going to move from copper interconnect to optics. And so we are deeply expert in photonics. And I just mentioned that's another outcome of both, the type of modality we've selected and the expertise that we've got of building things at scale.
Well, just very quickly, and you have to, and again, speak to me in layman's terms, because I'm obviously not as smart as you on this, but when it comes to the issue of photon loss, and I know there's been a lot of talk about this here, I mean, when I was looking at your published figures, I cannot actually find any real mention of them. I thought this was one of the hardest problems to crack in sort of development in the quantum space right now.
Yeah, so you're mentioning photon loss, and just that means that, I think people may be familiar with in digital electronics, even traditional computing, you can have data bits that just flip in value. And so you have to have some level of error correction to handle that and still have your quality calculations happen. So in terms of the reason why we've said from the get-go that we need fault tolerance, right, and now the industry has come around to that, is exactly because you have things like bit flips, and you also have, photons, just, erasure kind of things where they disappear. That's already built into the architecture, right? So that's not anything new, and that's something that is into the architecture. So, we've developed that. We also, focus on this scale. So that's something that we've been working on and making tremendous progress on, quite frankly. So back to the question of, are we close? Yes, we're close.
And Victor, final question. This really just has to do with just the broader nature of what's been going on in the AI tech space to build out here. And that's really the shortage of components, or at least the high cost of getting your hands on them. Are you dealing with any bottlenecks right now, whether it's photon sources, the optical switches, whatever, chips, anything else you need?
No, actually, in a sense, again, we are very focused on the supply chain. And by the way, it's, heavily all U.S. based. We've spent hundreds of millions of dollars over the past years with, hundreds of suppliers in the U.S. And if you include, some of our close allies, we're like 90+%, U.S. Supply chain. So no, we manage that carefully, and we don't see any bottlenecks. But I'd actually say back again, it's like some of the technology that we create on a way to build our machine can be leverageable and is going to be important for even traditional computing. So actually, we see an opportunity where some of our great technology can actually be part of the supply chain for non-quantum applications as well.
All right, Victor, really appreciate you joining us here. Fascinating subject. We'll catch up with you again soon, I'm sure. That's the CEO of PsiQuantum there, Victor Peng. Also, we should point out the former president of AMD, where he led the embedded and data center GPU business. When we come back, we're going to take a look at a couple stocks of the hour, including Eli Lilly. Obesity, it's big. Emily Field, she joins us after the break. This is The Close on Bloomberg. Time now for our stock of the hour. Taking a look at shares of Eli Lilly, up about 4.5% after the company raised its full-year revenue forecast and beating sales estimates, well, just pretty much across the board. Mounjaro, its diabetes medicine, beating Wall Street estimates. Zepbound, its weight loss medicine, beating Wall Street estimates. And of course, there's a big focus right now on its obesity pill, Foundayo, which got off to a strong start as well. Emily Field, head of U.S. Biopharmaceuticals Equity Research at Barclays, joins us right now. Emily, I know you've been busy all day long. Investors like what they've heard. Before we talk about Foundayo, let's go back in time. Let's talk about the performance of Mounjaro. Talk about the performance of Zepbound. Were you surprised?
Yeah, absolutely, because I think, at least in the U.S., we got prescription data and we can kind of track volume to a degree. But the big surprise for Eli Lilly this year has been the performance of Mounjaro, which is what they call Zepbound outside of the U.S. for everything, including diabetes and obesity, just because we don't get data on that. That beat Bloomberg consensus by 30% at the first quarter. And so we were expecting another strong quarter here in the second quarter, but it beat yet again. And then also the U.S. business beat ahead of expectations. Of course, some are trying to attribute that to price, but I think taking it holistically, the results today are just enigmatic of a very, very strong market across diabetes and obesity globally.
I mean, as you know, there was a lot of concern heading into this print, quite frankly, heading into the last few prints as to whether this obesity craze was just indeed a craze and something that would die down. Is there, or did you get a sense from talking to the executives that there is a long-term structural story here with them being able, not only on the revenue side, but also in terms of being able to maintain margins?
Yeah, absolutely. And because, Sigma, the managed care company last week said that they were expecting perhaps a slowdown in utilization. I think that really spooked people going to the results this week. However, and we just got off the phone with the company, it really seems that across the board, penetration in all of their addressable markets, which include not only obesity, but things like obstructive sleep apnea, osteoarthritis of the knee that they're exploring with some of their pipeline drugs, that there is just such a growing market for these drugs, and penetration probably remains in like the low single digits globally. So it still seems that even after this hype of the last few years, we're at the beginning of this story.
Talk about the pill. Obviously, Novo got to market first. Apparently, it was not quite the hit, at least not out of the gate. Foundayo seems to be doing a little bit better here. What's the discrepancy?
Yeah, so Novo launched their pill first, and so they launched right around the time of the new year, New Year's resolutions. Maybe there was some pent-up demand for an oral. The Foundayo prescription data got off to a slow start relative to Wall Street expectations. However, on both the call back in at the first quarter results and today, the company really made a point that their promotional efforts about this new medicine, it's really the first new medicine because oral Wegovy is still actually Wegovy that we've had in a few years in the obesity market, that they're really trying to be deliberate and slow in how they target physicians because it's a new medicine. And so at least the message from the company is that this is not slow. We're starting to see an inflection in the prescription data, but expect things to continue to check up as the weeks go along.
Just overall, I am just curious just about coverage, drug plan coverage going forward. Is that still a big concern for you?
Yeah, it certainly is, just because we obviously saw a little bit of a pricing reset when both Novo and Lilly announced their agreements with the Trump administration last year. And this element of the drug class having such a heavy element of consumer cash pay, which we really haven't seen across other drug classes, has contributed to a concern that pricing is going to be extremely deflationary. However, at least as we're going into 2027, it's still going to be the two competitors, Lilly and Novo. And so whilst we're probably going to see pricing deflationary higher relative to other drug classes that are more commercially covered, it still seems that, at least from Lilly's perspective, what they say is that every time there's a step down in price, there's a more than consummate uptick in demand, such that for them, revenue continues to grow.
Emily, real pleasure to have you. Emily Field, the head of U.S. Biopharmaceuticals Equity Research over at Barclays. A closer look at shares of Lilly, which are moving higher on the day, and so too are shares of Shake Shack. How's that for a pairing? The shares jumping after Starboard CEO Jeff Smith says he's taking a new position in the company.
We're economically one of the larger shareholders, maybe the largest active shareholder. It's several $100 million. And, we're really excited. It's just too cheap.
And that revelation just coming a couple of hours ago on the Deal Show right here on Bloomberg. Danny Berger joins us right now to talk a little bit more about this. The stock opened the day soft. Right now it's heading for what's going to be its strongest close in more than a year. What's going on?
So Jeff Smith, you heard it there of Starboard, basically saying this thing is just too cheap, which I have to say is a little bit different than what you would usually hear from activists. Activists usually says, I want to come in, I want to make huge plans to turn things around. And Starboard has historically done that with various restaurant and food ventures. But here he says this is cheap. And I kind of want to tinker around the edges. I want them to do more franchises, but I don't want to make any huge sweeping changes.
Well, that's what I'm curious. I mean, what is the plan? Because I was looking at the stock.
Right.
Just over the last 3 months alone, it's down like 30-something%, at least prior to today. And even prior to that, it's been a little bit of a dog, which is kind of surprising, given that for a while, this was kind of like, at least in the sort of the fast casual, fast food space, it was kind of the hottest thing out there.
It's true. Yeah. If you look at the comparable companies, like a Chipotle is also down year to date, but not nearly as severe, down 8% versus 18% for Shake Shack. I think Shake Shack specifically, some of its earnings hadn't been as bright. But Jeff Smith would argue that it is comparable, its growth rate, to a Chipotle, to a Cava, for example, yet it trades much more cheaply. So the plan, he says, is one, just let everybody know that this thing is cheap and that there is a clear growth story for them. But he thinks that they can expand their store presence more forcefully than they already plan to. And he says more stores. So he says that in order for them to do that, they need to franchise. That opening up just Shake Shack-owned stores will take too long if they want to push more internationally. And here in the U.S., they don't really do franchises. They do in airports and maybe some other sporting venues.
But that's been a deliberate strategy by Danny. Well, Danny Meyer founded it now, the new CEO. But I mean, the whole idea is that you have more control by owning your stores rather than once you franchise. A lot of issues come up with quality control and everything else.
That's why Chipotle doesn't franchise, right? Same exact strategy. Have that quality control. Smith contends that they've already done it. They've proven that they can choose franchisees who know the brand and can protect the brand. So it is something that they can go down. He said that so far they've been receptive, at least to beginning conversations. The CEO, Rob Lynch, is actually a CEO that Jeff Smith put in place at Papa John's at a previous activist campaign. So they know each other. So I assume there'll be some friendly attitudes there. But look, they haven't franchised for a reason, so they'll see if they take his word for it.
Danny, I haven't been in a Shake Shack in a while. I may go tonight.
I
used to like their hot dogs.
So I was actually thinking about it a lot because you had that fantastic interview with the Starbucks CEO where he talked about the most important thing for them has been product innovation and how that's really fueled them. Shake Shack is trying to do that. They have, if you go there tonight, they have a whole West Coast menu, so you can eat basically in and out, but at Shake Shack, I don't think they'd call it that. So they're trying to do the thing that, again, the Starbucks CEO said that they were doing, but apparently that's not enough.
All right. Well, the share is up about 11%. Just the fact that he even mentioned that on air on the deals show enough to give the stock what's going to be probably its best close since April of 2025. Danny Berger, you can check her out tomorrow morning at 9 a.m. right here on Bloomberg Television for the open. Meanwhile, we march towards the close. The S&P just hanging on by a thread, up 2 points right now. That would be a record high because, well, that's how record highs work. When you hit one the day before, all you need to be is in the green today to hit it again. Will we get there? Who knows? Mimi Duff joins us right now here in Studio 2, Senior Client Advisor and Head of the New York office over at GenTrust. Great to see you, Mimi.
Hey, good to see you.
I want to ask you for a prediction on today's market, but I will ask you to kind of look into your crystal ball a little bit longer term. We've gotten through this earnings season, and most of it, I should say.
Right.
And there was a lot of concern. We knew the numbers were going to be good, but the question was, how would the market react to it? Would it be enough to justify some of these multiples, justify some of these valuations? Now that we've seen some of the bigger players already, are you encouraged?
I think this earnings season is tremendously encouraging. Yeah, we've had just over 60%, announcing. We're 47% return, earnings growth year over year. Phenomenal number. But let's strip out some of those special numbers, the special one-offs. We're still in the high 20s in terms of revenue growth year over year. Really, really strong. And a lot of diversification across sectors. It's a broad earnings beat.
Well, I'm glad you bring that up because that was the kind of the consensus heading into this quarter, that this wouldn't just be big tech and AI. In fact, it would be almost the opposite. The big tech and AI would do their thing, but it would be kind of everyone else finally saying, look, we can participate too. I need you to throw a link, though, to the economy. And is this an economic story or is this an execution story for these individual companies?
I think you have to say it's an economic story, too. The unemployment rate is 4.2%. The GDP is running, call it around 2% annually. Add that to inflation, you've got some real nominal growth. I think it's a big economic story as well.
Are you confident in economic conditions? We get another jobs report this Friday, which seems to suggest things will more or less kind of be in line with where they've been the last few months. You saw that GDP report that we just got, and no one seems to think that we're going much lower than where we are right now.
Yeah, I mean, the forward-looking GDP estimates are really high. I won't even, they're really high. GDP it's backward-looking. It's heavily revised. The payroll print, though, we've been running at 100,000 average over the last 6 months. That's really, really good. We've had this wall of worry, and if we're really looking at the data, it's been good.
Yields. you saw what happened a week ago after Kevin Warsh opened his mouth, and there was this visceral reaction in the bond market. That's subsided a little bit, though. Yields coming back up here on this Wednesday. Does that become more of a story going forward, higher yields?
Yeah, so I just want to paint a broader picture because in many ways, the bond market is a nothing burger for this year.
Oh, wow. Okay, those are fighting words.
Hear me out here. 10-year yields are up close to 50 bips, depends on what time of day you're looking, 45, 50 bips. Front end, higher, up to 70 bips.
Yep.
The ag index is flat on the year. So, yes, yields have repriced, but we came into this year thinking that we were going to get rate cuts, that we were going to have some economic, stumbling, and instead now we're pricing in one hike. We've got better data. One hike this year, maybe some odds next year. It's kind of like the way that the market has developed and the economy has played out. You would argue for higher yields in that sort of situation with inflation where it's at.
Well, as you look forward over the next few months, though, I mean, is there a sort of a big risk that you're at least keeping an eye on? Not saying it's going to come to fruition, but that you are going to make sure that you're watching.
Yeah, so many, right? I mean, look, we have hedged and we continue to look for broadening out. We've hedged the Mag 7 names. We think that this is a story of everybody else winning and everyone else gaining. And thus far, the returns show that, right? Every, mid cap, small cap, non-US, equal weight, they've all beaten the Mag 7 this year by a healthy margin. So we think that rotation is going to continue.
All right, and just real quickly before we let you go, when we talk about this rotation and what it's dependent on, ultimately it's dependent on earnings. I mean, as everything in the stock market is there any concern that if rates are high, cost of capital is high? Let me rephrase that. Cost of capital remains high, and that knocks maybe the AI trade down a bit. Does that drag everything else down with it, or do you think that could be sort of its own sort of sector-specific thing?
Yeah, I think the high rates are playing more into the housing market and consumers. Yeah, cost of borrowing is a problem. On the AI side, since you brought that up, the top AI companies used to be really cash rich, and now they're spending so much on CapEx that dynamic is flipping, right? So we are going in the broader equity market from a net negative supply to a net small positive or much more equal, given that they'll slow share buybacks. Right, but they'll be issuing debt. So it will be a bit more costly for them. But I worry more about the housing sector and other consumer sectors with the higher rates.
Okay, all right, Mimi, always great to have you. Mimi Duff, Senior Client Advisor, Head of the New York office at GenTrust, counting us down to the closing bells. We're just about 3 minutes there. The S&P slipping into the red. The NASDAQ has been in the red for the last hour or so. The Russell also down. Transport's down as well. The Dow Industrial Average, though, for some reason or another, up 0.6%. That's going to be good enough for a record high. Despite the red on the screen, it's still pretty much an up day here with the majority of stocks in the green, including names like NVIDIA, Apple, as well as some of the travel stocks like Booking as well. We're going to break down all of today's market action, and we're going to have full coverage of those results from SanDisk and Western Digital with our global simulcast that starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick taking you through to that closing bell. It's a global simulcast. Carol Massar and Tim Stenovic, they join us now. Welcome to our audiences across all of our Bloomberg platforms, television, radio, our partnership with YouTube. A little bit of a sentiment shift here on the day, Carol Massar. Coming off the record highs yesterday, we are modestly lower for most of the major indices that we should just flag for our viewers and our listeners. We are going to get some major earnings coming down the pike in just a matter of minutes, including from the best performing stock of the year, SanDisk.
Yeah, I'm looking forward to that. Western Digital also coming out with earnings. You've got Expedia, eBay, Duolingo, Elf Beauty, Honeywell Aerospace, DoorDash. I mean, there's a lot.
You didn't say AppLovin, did you?
AppLovin?
You didn't say AppLovin.
I didn't. I left that for you.
Oh, wow.
AppLovin.
That's because I'm loving you, and I'm giving you AppLovin.
See, Romaine?
Wow. Get a room, you two.
The love over here.
No, we're like,
Well, you're actually in a room, but all right, I got you. But we get to this idea of the earnings season. I know, look, so much hay has been made of the AI trade.
Yeah.
You were sitting here yesterday when AMD and SpaceX crossed the wire, and we're going to hear from SanDisk, a stock that's just took a beating last month, down 50% in the month of July, still up like 400+% on a year-to-date basis. But it gets to this idea of just how much risk appetite is still there for some of these high multiple names.
Agreed. So we will watch, and we will be breaking them down in just a moment. But we've just got 20 seconds. And will it be a record on the S&P? Doesn't look like it's going to be that way, Romaine.
Yeah, it looks like the S&P fading into the close here. It had been holding right around the waterline for most of the session here, but now down almost 14 points. It looks like that's where it's going to settle. That's going to basically be down about 0.2% on the day. The Dow Jones Industrial Average, which closed at a record high today, adding about 260 plus points, or 0.5% today. So yes, that is another record high. The NASDAQ Composite and NASDAQ 100 each down about 0.8%, and the Russell 2000, Carol, losing about 18 points, or 0.6%.
Almost an even split in the S&P 500. In the S&P, we had 245 names move higher, 256 names move lower today.
Yeah, and we talk about sort of what's been leading the market. Yesterday, on the sector basis, it was all tech. Today, it was materials up 1.5%, healthcare up 1% on the day, financials up 0.2%, and then everything else just faded. Technology stocks as a group basically unchanged. Communication services down 2%. And a big part of that was the big downdraft that we saw in Alphabet.
All right, guys, let's get to some of the individual gainers as we await some earnings. NVIDIA, that stock up 3.4% off its highs, but nonetheless a gainer on this Wednesday. That company, as I mentioned, up more than 3%. Stock gaining after SpaceX said it would exclusively use NVIDIA AI chips. SpaceX expects to have approximately 2 gigawatts of computing capacity by the end of this year, could rise to as much as 10 gigawatts next year. That's its projections. Nonetheless, that gave Remain a boost to NVIDIA. The stock up roughly 17% year to date.
Yeah, a little bit earlier, we got earnings out of Booking. Those shares rallied 12% on the day. We're now hearing from one of its competitors, Expedia. Those shares slightly higher in the after-hours trade after the company said gross bookings in the quarter did come in slightly above estimates at $33.93 billion. Revenue, $4.32 billion. That's also a beat. Adjusted EPS, $5.76, and that is a beat. Here's your guidance for the full year. The company says expect revenue of $16.05 to $16.22 billion. That is a raising of their guidance. Their previous guidance was 15.6 to 16 billion. So basically a beat and raise quarter for the company as you see the shares just slightly higher, up about 1.5%.
Yeah, the stock's actually up about 12% year to date. Looks like it might be actually in the regular session, maybe closing at a record high. But nonetheless, we did see it hit a 52-week high in today's session. Again, investors liking what they heard from the company, up about 5% here now in the aftermarket. Second quarter adjusted EBITDA, 1.12 billion versus 1.04. And then in terms of the outlook, just to go back there, sees third quarter revenue 4.65 to 4.75. And Tim, that is a boost. Estimate on the street was 4.66 billion.
Yeah, for Expedia Group, shares up 4.8% right now. Ariane Gorin, the CEO of the company, she said, quote, "We continue to strengthen our marketplace through more personalized consumer product experiences and expanded supply across our business while leveraging AI as a force multiplier to innovate faster and operate more efficiently." I guess I want to know more details about how they're using AI and how it made them more efficient. I think people could say, okay, well, the conversation is starting to shift from these companies now adopting this technology and making them more efficient. So where does that show up on the bottom line?
All right, we're going to wait for some more earnings. I'm going to go back to some gainers. Shopify, have to mention, at its highs, up almost 25% today, finishing the day with a gain of about 17%. Number one gainer in the NASDAQ 100 today, the highest level since January. The e-commerce giant reported third quarter revenue outlook beating expectations, strengthening the view that it faces limited disruption from artificial intelligence. Revenue is seen growing at a low 30s% rate ahead of Wall Street's expectation of a 27% jump. It would mark the sixth consecutive quarter revenue growth exceeding 30%. Keep in mind, the stock has definitely been under pressure. It had fallen 23% this year through Tuesday's close. Stock now still down about 10% amid concerns about AI disruption, but maybe easing some of those investor concerns remain.
Block, XYZ, Jack Dorsey's company, out with its earnings. Second quarter revenue does appear to be a beat, particularly with its Square segment revenue. But the redhead has to do with their third quarter forecast. The company says operating income for the current quarter will be $875 million. That's above street estimates of roughly about $866 million. The company also says that for the quarter, it expects gross profit of about $3.13 billion. That's just a nudge higher than what the street was looking for this particular quarter. The company also providing some full year guidance. It's also just a smidge above analyst estimates.
Yeah, absolutely. Just going through the snapshot here, you mentioned some of the highlights. Just looking for some commentary here. So again, sees adjusted operating income for the third quarter, $875 million. The estimate was $865.7. Sees gross profit of $3.13 billion. The estimate is for $3.12, so a little bit better. And again, seeing adjusted operating margin of about 28%. Tim, that stock bouncing around in the aftermarket, now unchanged, but we did see it a little bit higher earlier on.
Remember, this is the company that a few quarters ago shocked the markets by massive layoffs. A lot of people in wake of that said, okay, well, it was because of overhiring that happened during the pandemic. But again, going back to what everybody's looking for, okay, did AI replace these employees? Is AI making the company more efficient? Shares of Block, initial reaction now up more than 4% in the after hours.
All right, well, we're starting to get some numbers trickling out here right now for Western Digital, the company that now wants to be referred to as a WD, one of the big memory storage device makers. The company says that net revenue for the quarter did come in at about $3.75 billion. The street on average was looking for $3.68, so that is a beat. Adjusted EPS coming in at $3.56 a share. The street was looking for $3.31. This release is a bit of a beast to parse through, but you see the reaction in the shares there. They're down about 12%. So the numbers for the most recent quarter did beat, but clearly something else in here that investors are focusing on, and it might have to do with the forecast. The company says that for the current quarter, which is its fiscal first quarter, it expects revenue of $4 billion to $4.2 billion. The street was looking for $4 billion on average, so the low end of that range, pretty much on the nose of what the street was looking for. The company says gross margin in the quarter will be 56%. The street was looking for 53.8%. The company says operating expenses in the quarter will be lower than what the street was looking for.
What's the problem?
At $398 to $400 million. And adjusted EPS in the quarter will be $385 to $415, the low end of that range above the average of street estimates.
What's the problem?
High expectations?
Yeah, well, the stock's up more than 200% year to date. So I would definitely go into that. I mean, again, going to some of the outlook here, the company sees first quarter adjusted gross margin 55% to 56%. The estimate was 53.8%. So that's, I would say, upbeat there. The company sees first quarter operating expenses, looks like they're reining them in a little bit. $390 million to $400 million. The estimate was $475.3 million. And then Western Digital sees first quarter adjusted EPS $3.85 to $4.15 a share. The estimate on the street was $3.83. So this is I got a little head scratching here.
But the company commentary from the company's CEO, now as Romaine mentioned, WD is how the company wants to be referred to, Irving Tan, it says that that they have confidence in demand. He says, quote, as global data creation continues to accelerate, we enter fiscal year 2027 with continued confidence in the durability of demand and with increasing visibility into our business. With our scale, technology leadership, and operational discipline, WD is well positioned to capitalize on the secular data growth opportunity and deliver long-term shareholder value.
I just want to point out real quickly. We are still waiting SanDisk, and I should point there is a ton of trading activity going on in it right now. Those shares are also down about 8%. The release has been posted on the company's website. We have not yet gotten it on the Bloomberg terminal, and we should also point out that the files on the company's website right now not actually coming up here. So it's not clear whether people have actually seen the numbers just yet and are reacting to that, or whether they're reacting to what they heard from Western Digital. Of course, Western Digital, the company that spun off SanDisk last year.
We've got it on the terminal now. SanDisk, fiscal fourth quarter revenue was $8.97 billion, up 51% sequentially. GAAP net income reported at $6.9 billion. Sequential revenue growth came approximately 1/3 from higher volumes and 2/3 from higher pricing. Which is always great for margins, but it's something to keep in mind in terms of when we look through these numbers. Fourth quarter non-GAAP diluted net income per share was $39.25 a share. So we're just starting to get some stuff here, Romain.
Yeah, I'm going to hold off just a little bit here. I'm not quite getting all of those on my terminal as well, but you see the reaction. And it gets back to this idea that you were getting at, Tim, this idea of high expectations. Of course, Western Digital had been on a tear, but SanDisk had been on even a greater tear here. And it raises a lot of questions as to exactly what actually constitutes a real beat in this day and age.
Well, yeah, we got Jake Silverman coming up. He covers semiconductors for Bloomberg Intelligence. He's going to be joining us. But look, the backdrop is that their demand is high for this stuff. Look at what the stocks have done so far this year. Look at what Apple has had to do as a result of higher input costs, raising prices for certain items. The question is, how long does that demand go on? And is there actual competition from China that U.S. companies can have access to?
Just going through SanDisk a little bit more, expanding their share repurchase authorization, approving an additional $14 billion buyback, bringing total remaining authorization to $15.5 billion. But you're right, we're looking for some comparisons here. But I'm always a little suspect, too, going back to who were we talking about? Was it Western Digital cutting their CapEx and why? When it is reined in a little bit. Why is that happening? All right, guys, that is a wrap. SanDisk down just shy of 5%, now 5% in the aftermarket. That is a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We do call it the closing bell. Remain continuing there over on the close on Bloomberg TV. Tim and I back here on radio on Bloomberg Business Week Daily. We'll see you again, same time, same place tomorrow.
Stick with us. We're going to get you some more clarity on those earnings just fresh off the wire from SanDisk and WD. Stick with us. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. We just got the closing bells. The S&P 500, which had been holding the waterline for most of the day, coming off of yesterday's record high, now down about 0.2% to close out the day. The Dow Jones Industrial Average is going to finish up the day at a record high. The big lift today really coming from materials and healthcare stocks. You also saw some interesting individual stories, including from Shake Shack having its best day since April of last year. And that was largely on the back of some comments that Starboard CEO Jeff Smith made about taking a stake in the company, trying to unlock some value. Shopify also having its best day since August of last year, up about 17% on the back of an incredibly impressive earnings report. Meanwhile, you saw Alphabet take a leg down about 4% as you had a key departure from one of their executives in the AI space, as well as a bit of a shakeup over at DeepMind, raising some questions here about what's going on behind the scenes. And AMD, which reported earnings after the bell yesterday, closing out today down 7%. And that does bring us to our top story, the next catalyst for this market. It's happening as we speak. Earnings from memory chip maker SanDisk, the best performing stock of the year. It plunged 47% in July. But some people, they're eyeing a buying opportunity here. Ed Yardeni says the broader tech sell-off that pushed the NASDAQ 100 into a technical correction last month actually helped to shed the valuation excess out there and clear the stage for a rebound. He cites a NASDAQ 100 trading at 22 times expected 12-month profits, one of the lowest valuation premiums, he says, to the broader market since 2017. He also cites Ken Griffin's Citadel, snapping up assets in Leopold Aschenbrenner's highly levered situational awareness hedge fund last week. Remember, when it comes to a once-in-a-generation market event, fortunes, at least the durable fortunes, they're made not on the upswings, but on the downswings and on the crashes, finding bargains in the wreckage, being greedy when others are fearful. But of course, you also have to have conviction in the fundamentals. And right now, for some of these AI stocks, the fundamentals show price multiples at a significant discount to the market on a forward price to earnings basis. Let's talk about some of those fundamentals. We just did get those earnings out of Western Digital. It did appear all of their key metrics for both the current quarter as well as the previous quarter did meet street expectations. Nevertheless, those shares down about 9% here in the after hours trade. SanDisk, the best performing stock out there, now coming out with its results. The company did say that its fiscal fourth quarter numbers did beat, including an adjusted EPS number of a whopping $39.25 per share. The street was looking for 34.37. However, they're providing guidance for the current quarter, the fiscal first quarter, and that did appear to come in a little bit light. The company says adjusted EPS for the current quarter, $44 to $46 a share. The street on average was looking for 45.58. So basically, the top end of that range is right around the average of street estimates. As for revenue, the company expects $10.3 to $10.8 billion, and that is well below the average of street estimates. The street was looking for 1Q revenue of $11.16 billion. Mark Newman joins us right now, senior analyst over at Bernstein, to talk a little bit more about what we learned. Let's start off with the SanDisk numbers here. I guess the revenue forecast, some people are seizing on here. I mean, I would quibble still, earning $10 to $11 billion in revenue in a quarter for a company that was making, a fraction of that just a couple of years ago was still impressive. But is the growth story still there, Mark?
Yeah, I think the growth story is still there. And to your point, I mean, this was a $5 billion market cap about a year ago. So put that into perspective, the stock has been a flyer. It actually is still a growth stock. The problem, of course, with memory stocks is price is extremely volatile. There's reasonably high expectations going into the print. The price is going to continue to be strong. We just look at the numbers. It seems like the actual quarter was, way above expectations, way above consensus, but they have been pretty conservative in guidance recently. Like look at last quarter and how they just smashed it out of the park again this quarter, and how they guided for it. Mm-hmm. So it seems like a quite conservative guidance, but I'm not too surprised by that. And obviously we'll find out more on the call in about 15 minutes why it's so light, and I would assume there's a reduction in the volume growth versus expectations.
Yeah, and just to put a finer point on some of these numbers, particularly with regards to the quarter that just passed, that fiscal fourth quarter, adjusted gross margin, 84.6%, which is just, it makes me chuckle to even say that. The estimate was for 81.5% here. Free cash flow, $7 billion. But I want you to talk about what's on the balance sheet right now. Cash and cash equivalents did drop, and they're now at $4.76 billion, which is about half of what the street was looking for. They were looking for around $8.5 billion. Is that something that investors should be worried about, or is this just sort of the natural cycle as they sort of try to reinvest in the business, build out capacity? We're going to see these types of fluctuations on the balance sheet.
Well, I haven't really seen the details, but they have, they announced a $10 billion buyback. I think they're announcing another buyback today. So in those numbers, perhaps some buybacks, I'm assuming. I think this is great. I think share buybacks, returning money to shareholders. Again, I don't know the details because these numbers are just hitting, but to returning cash to shareholders, buying back shares, I think that's a huge positive. The free cash flow is massive. It's significant. It's more than what their market cap was, the free cash flow in one quarter. So I think all of these are extraordinarily positive trends, but shares are up 4,000% in the last 12 months. So there's been a bit of profit taking recently.
And just to put a finer point, that buyback program now approved at $14 billion. The company says overall it has remaining authorizations of about $15.5 billion in buyback authorization. So that could be some support for the stock. There's still this idea, though, of the growth rate. And I started off asking you about that because we talk about revenue growth, I think on a full year basis was something like, 200%, 175, 180% on a year-to-year basis. And it gets to this idea that most people know that one way or the other, that's not sustainable. What's the glide path for this company to where they can sort of find some equilibrium that's going to keep investors happy, but also make sure that there's still some sort of faith in realism to what a growth rate should be for a company of this size?
Yeah, I mean, we're coming from a period where they've just got insane levels of price increase quarter on quarter. Last quarter, it was 140% quarter on quarter price growth, just insanity levels of pricing growth. And this quarter, I've not figured out exactly what the price growth is, but it's certainly a lot lower than that. Anything that's positive in pricing is great because volume continues to grow. As technology migrates, you're getting more gigabytes per wafer, and cost comes down per gigabyte as well. So, I think for the stock to work and for the multiple to work, a more normalized single-digit to 10% or teens ASP growth, pricing growth per quarter is still very positive.
All right. I think we lost Mark there. Mark Newman there, Managing Director and Senior Analyst over at Bernstein. The shares of SanDisk down about 5% right now in the after-hours trade. Western Digital shares also under pressure. Both of those conference calls kicking off at the bottom of the hour, so in just about 9 minutes' time. So we'll get a little bit more color, hopefully, from some of those CEOs, not just about the numbers themselves, but about this big bottleneck going on right now in the memory chip space. A big shortage that, of course, has been a tailwind to their businesses, but obviously a big headwind for all of the big consumer electronic brands out there. MS Hwang covers this sector better than anyone. He's the research director over at Counterpoint. And I do want to get your sense here about kind of how tight things are right now, and not so much just from the perspective of how it aids a company like SanDisk or Western Digital, but whether there will be any relief for the buyers, for the consumer product, for the consumer electronics companies that are having to pay up in order to get these components?
Yes, exactly 1 year ago, every investor is asking me the same question: how long would this last? Supply shortage will last. That means everybody didn't really put their portfolio into a full-fledged. Recently, we got some cases in hedge fund situational awareness. But now I'm here in Santa Clara and the Flash Memory Summit. Every supply chain companies are asking me the exactly same question: how long?
Are you able?
That means everybody has a hope that these supply shortage will ease sometime in the future, maybe 1 year, maybe 2 years. So up until then, the hyperscalers is not going to stop buying, and the people are continue to buy. So there would be some mechanical adjustment. Some companies are getting difficulty to find this component. But fundamentally, we are all looking for larger and faster memory for AI. That doesn't change.
So if the demand doesn't change or subside, what about supply? I know SanDisk, all of these major chip companies have said that they are going to increase capacity. Some have already broken ground on new facilities. How long does it take before we actually start to see a meaningful increase in supply on the market?
Good point. The supply has been already accelerating in terms of magnitude of new buildups. And earliest the time that we can get as an output, wafer output, is going to be the Q3, Q4, 2027. So the most of the impact of the supply growth is going to be start from 2028. So up until then, supply demand is going to be still remain very tight, and we are going to see onward pricing appreciation. And these companies are going to report unprecedented high level of earnings going forward.
When you look at the consumer electronics companies, and not just consumers, but really across the board, all of the companies that need these components, who is suffering most right now?
Obviously, it's a business model. Value for money companies, exactly, most priority for now in terms of allocation from a supplier perspective. The first priority is AI infrastructure, which is CSPs in US. And then we can go down to tier one OEMs in server market, and then smartphone companies. And then it keep goes on. So biggest hurt is in consumer side, especially smartphone and PCs and game machines. Automotive and networking are more or less infrastructure companies, so they can be some saved area. But value for money smartphones, especially in China, is being hurt the most. And we are going to see some meaningful market share shift to the leading groups such as Apple and Samsung going forward.
With regards to the issues with regards to supply and new players, new entrants into this market, there's been a lot of talk about what China can do, what it might already be capable of doing. When do you factor that into your timeline where they might actually be a big factor with regards to supply?
China companies are amazing, growing much faster than expected. And CXMT is already capable of delivering most of the commodity DRAMs. Without HBM, still it is a big issue. AI is the first priority in China too. So if CXMT focus on HBM manufacturing, then we are going to see similar level of disruption in commodity DRAM manufacturing in China as well. So everything is sold out in China too. Mm-hmm. And we are going to see the similar supply shortage happening in China. In a long term, these companies are going to continue to grow. So the meaning of the China company is not just a number. Whenever they can make something they require, the entry barrier of the Chinese market is going to be a lot higher. That is a real threat to the rest of the world.
And we already seen reports from Bloomberg as well as some other Chinese news outlets that at least they do appear to have actually produced smartphone memory chips that are almost on par with the industry standard. Is that your belief as well?
Yes, smartphones, PCs are fine. They're moving to the server. So we are recently hearing that global server company are qualifying their chips in both DRAM and NAND. Mm-hmm. The only part that China is not capable of delivering the right product is HBM. And initially, we are expecting that may happen in end of this year.
All right. MS, really appreciate you taking time for us. MS Hwang, one of the best researchers out there when it comes to this space over at Counterpoint. When we come back, we're going to pivot to the entertainment and the advertising space with Mark Douglas. This is Bloomberg. Shares of ad tech firm Mountain finishing the day in the green after its recent earnings report yesterday showed revenue up 21% on a year-over-year basis. Now, the results come on a really busy stretch for media companies. Remember, we got Disney this morning. We got Paramount as well. We're going to get Warner Brothers tomorrow. And there's a lot of talk, of course, about overall the streaming space, the connected TV space, and more importantly, the ads that feed into them. Mark Douglas knows more than anyone about it. He's the CEO over at Mountain. Mark, great to see you here.
Great to see you.
Talk to me about where we stand right now in the connected TV space, because I mean, I'm going to start with Disney's earnings, because one thing that jumped out at me when I saw them, I mean, obviously their streaming business is doing well, or at least much better than what analysts had expected. 64% profit growth in that business. I think the revenue growth was like 14%. Ad sales overall for them, and I know that kind of mixes streaming with the more linear side of their business, that was only up like 3% here. Is that a disparity that we should be paying more attention to? What's going on?
Yeah, I mean, well, Disney has a lot of strength, obviously, in ad sales. They're essentially the largest. So that in and of itself, it's hard to grow when you're already number one. But the year itself, I think a big theme for this year is bringing live sports to streaming. There have been so many big events with the World Cup, obviously tentpole events like the Super Bowl, Olympics, things like that. And so that has been the theme of the year, and that has been going extremely well, I think, for every media company involved in that. And I think you're going to continue in the future to see live sports on streaming platforms be a big driver of future growth.
Is that? But I am curious. I know that this has been like the holy grail, but I mean, the sports business was kind of a drag for Disney primarily because of how much it costs. So I guess my question is, how does it balance out in terms of what they have to spend for the rights to air these sports with regards to what they end up collecting either through ads or other sponsorships or subscription fees?
Yeah, well, I think for Disney in particular, ESPN has been considered somewhat in recent years under-monetized because it was primarily available on streaming, has live sports as and of course news, the Sports Center and others. And so I think that is considered, potentially a big bright spot for growth for their ad sales and in particular for sports on streaming. So I think that's the thing to look for as Disney moves forward.
I want to get your thoughts, particularly on kind of what you do at Mountain, because I mean, you deal with a lot of smaller businesses looking to sort of, get exposure at these sporting events or really just on the connected TVs overall. Have you seen any sort of pullback in their spending relative to, the gigantic players like, the Coca-Colas or whoever?
Yeah, not at all. As a matter of fact, I would say that right now the industry as a whole, there's not any pulling back occurring. What you're seeing is that the biggest advertisers are very consistent in how much they're spending. I see no reason that's not going to continue in the future quarters in the second half of the year. And then you have small and mid-sized advertisers as kind of the growth driver for the industry. And Mountain is like basically tip of the spear at that. That's what we refer to as performance TV, and we essentially created that concept, that category. So, it's a very, very healthy environment. And what I mentioned earlier in terms of live sports and just kind of more people moving to streaming is just kind of the base that everyone is growing on. The other thing, one other thing I'll mention is I think, for a while it was Netflix and then Disney, and you're seeing all the streaming networks get better at attracting, by producing better content. They're getting better at bringing more subscribers. So I expect the whole sector to do really well over the next few quarters.
But it's shifting a lot too, and I am curious what you think about this idea of kind of, are we going to get back into this sort of gatekeeper mode? Because, I just even look at my own TV at home, and I won't say what brand it is, but I've noticed some big changes in sort of the portal, if you will. Obviously, we talk about Roku, Amazon Fire, obviously Samsung Vizio, all of that in there. Are these companies trying to sort of become, I guess, the toll road, if you will, or are you still going to be able to circumvent them if needed? Or maybe work with them? I don't know.
Yeah, so things have been transitioning because for a while it was you needed like a Hulu or you needed a Roku basically to give you the live content, and then you had all the episodic content, your favorite shows. But what's happened is all the live content is now available streaming also. And so I think that kind of gatekeeper role, if anything, it's kind of declining in importance. There's less of a reason to have that gatekeeper. And so like if you wanted to watch World Cup, you could just go directly to the Fox app and their partners, it was available on Peacock and others. You didn't really need like that equivalent to linear anymore. So if anything, it's going the opposite direction, where you just have your favorite networks. The networks are putting out all forms of content, and they're even partnering with each other to make sure they get the maximum reach. If someone's not a subscriber on their network and they have something, they'll partner with another network to make it available there too.
This goes beyond the reach too. We've heard a lot of people talk, and brands talk about this idea of wanting better engagement, not just the eyeballs, but obviously someone clicking through to buy, but just the idea of feeling more of a connection. How do you sort of adjust, not only on your end at Mountain, but for all the other players out there to make sure that it's not just sort of a billboard in front of my face, that it is something that will draw me in, engage with the brand, and obviously translate that into sales at some point?
Yeah, so it really comes down to one is that very old adage in television advertising. I know I'm wasting half my money. I just don't know which half. You don't need to waste anything anymore because you can target everything. And so I think even the biggest brands are now expecting very, very targeted campaigns. They're aligned with the consumer they want to reach, and they can even build creative align with that. So, and then now with our platform, you go down to the small, mid-sized businesses that don't have the biggest budgets. So really aligning with who's the perfect consumer to get that content. That ad it's just vitally important. It's a big part of our value proposition. So, all the brands are essentially seeing performance as really key on all sectors. It could be search, social, now television, in the form of performance TV, and they're all bought into that.
Mark, always appreciate it. Mark Douglas, the CEO there over at Mountain. Meanwhile, we do want to check in on the after-hours trade, those conference calls with SanDisk and WD, the company formerly known as Western Digital, underway. SanDisk shares still under pressure, down about 3%, beating on several key metrics, but a forecast that comes in a bit light. Western Digital guiding higher, also beating in the most recent quarter, but those shares still taking a beating, down about 9%. Elf Beauty down about 5%, despite boosting its adjusted EPS forecast, and one of the few bright spots out there is in the travel space. Expedia boosting its full-year sales outlook on strong travel bookings. We'll be back in a moment. This is The Close on Bloomberg. BNY announcing a new partnership with Galaxy Digital to build out its digital asset infrastructure. The move comes as the bank, which already oversees $62 trillion in assets, continues to move into the digital asset business. Joining us right now is Emily Portney. She's the global head of BNY's asset servicing business. You have a lot to do these days. I do want to start off with the digital asset side, and we'll get to more your core competency here. But this kind of just struck me when I saw it, because I know we've heard from the CEO and the CFO talk a lot about doing a little bit more in this space. I mean, if you're going to be a custodian, you're custodian for all assets. How does this sort of expand what you do?
Well, the announcement with Galaxy is just one of many partnerships that we've recently gone to market with. It allows us to do staking for assets that are under, digital assets that are under custody. But what I would say, if you just step back for a moment on digital assets more broadly, is that there's not a client conversation today where digital assets or tokenization doesn't come up. And whether or not an asset manager is about to launch a product next week or in 6 months, they want to know what's going on in this space. So the conversation has really become mainstream. And last week, we also announced a new capability. It is called Digital Asset Transfer Agency. I don't know if you know anything about transfer agents, probably don't, but they sit behind every fund transaction, and they're the books and records, and they create the shares of funds. And so we now do that on chain. And the reason why that's very important, that the books and records of a money market fund, for example, is on chain, is because suddenly that makes the money market fund available for 24/7 settlement, and it also makes it mobile. So you can actually use a money market fund for financing a transaction on the weekend, for example.
As you expand, and some of this has just come with the dynamics that we've been seeing in the industry, a broader industry, and obviously they've come knocking on BNY's door because you've been doing this for a gazillion years. I am curious, though, about just the fee pressure. I mean, there are a lot of competitors in this space as well. How do you sort of maintain that growth, but at the same time maintain some semblance of profitability of what you're doing?
Well, at BNY, we have had a lot of success over the last several quarters and have announced pretty incredible performance. With that, organic growth, I think we've had 10 consecutive quarters of organic growth. And look, fee pressure is just part of the business, but if you service clients well, and if you are competitive and differentiated in your offering, which is exactly what we're doing along the lines of DA, or digital assets, as well as many other innovations, then clients are willing to pay for service and pay for performance.
With regards to the servicing infrastructure, particularly in the realm of alternative assets and the idea that you're starting to see more individual investors gravitate to alternative types of products, whether it's in a wrapper or as a standalone, how much has that business grown? And have you had to make significant changes to your infrastructure to accommodate this or not?
So alternatives more broadly, private markets specifically, is definitely a growing segment of the market. And it's just becoming, ultimately a staple of an investment portfolio. Whether it's for enhanced yield, whether it's for further diversification, it's an important component, really, of any investment portfolio. And so if you're an asset manager, you're kind of thinking about, gee, first of all, do I have those products in my portfolio, in my repertoire? If not, you've seen some tie-ups of different asset managers, traditional asset managers and alternative asset managers. There's a question, too, around how do you access that space? The distribution channels are often different for alternatives. There's also a growing attraction of alternative and private market exposure for more mass affluent and retail investors in different wrappers. And then the last thing I'd say is if you're the investor on the investor side, there's a big push to want to see your public and your private market portfolio together in one single pane of glass so that you can look at your exposure and your attribution across both. So as the market is getting more complicated, it is partners like ourselves that can help to certainly develop and deliver those holistic investment solutions across public and private markets.
With regards to where you see growth going forward, is it going to be kind of in that space with regards to private, when I say alternative, I'm talking about private assets and the broadening of that market, or is there somewhere else you're looking?
Certainly private markets will continue to be an important key growth area. ETFs continue also to be a very important growth area, and especially active ETFs, likewise the wealth segment, and of course, as we started, digital assets.
Digital assets. Final question, and I know Robin Vince has talked a lot about the own deployment internally of AI and this newfangled technology. I assume in your business you have to be all in on that.
Absolutely, absolutely. And we were an early adopter of AI. Frankly, Robin is evangelistic about it.
Yes.
He used to come
so
to.
I've heard. Yeah.
He used to come to our meetings and talk about vibe coding on the weekends. So I mean, it got us all very interested. And look, it's about creating more capacity. It's about reducing risk. It's about servicing our clients better. We do have digital employees now, about 180 of them. They have names, funny names, email addresses. They have access to our systems. They're listed in our phone book, and they do things like payment repair, answer custody queries, help with client onboarding, and it's just all about, of course, they're supervised by humans, but of course, it's all about being faster, more efficient, and servicing our clients better.
A year from now, do you think that those 180 will be a lot more than that?
Probably. We'll scale up as appropriate.
All right. Great to have you here, Emily.
Thank you.
Emily Portney, BNY's Global Head of Asset Servicing there. And we were just talking about private markets. We do want to stick into that space and talk about Ridgepost Capital, just posting earnings. The CEO, Luke Sarsfield, joining us right now to talk a little bit more about that after his assets crossed $50 billion in the second quarter. You've done a lot of growing as of late.
We've been trying. Obviously, we're really focused on expanding the platform and serving our clients.
So give me a sense here, because you're more focused on the institutional side, fund to fund.
Institutional and third-party retail.
And you are
as well.
third-party retail.
Yep.
But kind of break that down, because, I mean, these are kind of a hodgepodge of businesses that you've kind of melded into one cohesive company here. So give me a sense here as to who you are going after most. Is it the institutional?
So when you think about what we have a bunch of specialized, targeted offerings across the private markets, venture capital, private equity, and private debt. So we can really be a full solution provider. And so I think there's a lot of interesting dynamics there. There are certain clients of ours that want to engage with us across one or several parts of the portfolio. And there are a lot of clients who want to engage with us more holistically. As you can imagine, institutional clients, large allocators, insurance companies, pensions, sovereign wealth funds are going to be much more interested in what we can do for them across that full spectrum of offering. And we're really focused in the middle and lower middle market. And so our ability to do that, I think, is differentiated for them.
Well, let's talk about that a little bit more. And we just I think it was just yesterday, we had Randy Schwimmer from Churchill Asset on, who's, of course, been banging the drum on the relative attractiveness and safety of the lower and lower middle market here. Is that just because it's AI proof, or it's more economically resilient? What is the selling point?
I actually think it's really different. And I think sometimes the risk is people hear middle market, they think smaller and they think riskier. In fact, quite the opposite is true. It's actually more stable and more resilient. Let me tell you why. First of all, a lot less capital going against a much broader opportunity set. We have 5 times the GPs of the upper market, 10 times the companies that we're able to invest in. We can be much more targeted, much more selective. Number 2, we can buy the companies in the right way. In the upper market, you're looking at deal multiples that are, double-digit kinds of EBITDA multiples. We're buying things at 7, 8, 9 times EBITDA, and with a lot less leverage, right? We're buying things with 3 to 4 times leverage, upper market, 6, 7 times leverage. The net effect of all that is we're getting great assets, we're getting them at the right price, and then to your point on AI, we can bring AI and we can bring a lot of operational excellence to bear to make them better, to make them more resilient, to help them grow faster, and ultimately we have a broader exit pool because it's all the large folks we talked about.
Are you seeing, though, but you got to be seeing a lot more competition there. I know you're seeing a lot more competition there.
I would say, look, obviously it's an attractive part of the market. And of course, when there's attractive parts of the market where there's an opportunity set, people come to it. But there's 2 things we have, I think, that are really powerful. One is the benefit of incumbency. We've been at this for 25 years in some cases, even more in some cases. Our largest strategy, RCP, just celebrated their 25th year anniversary. They have been doing this an incredibly long time. And so that durability, that flywheel that they have in the middle market is something that nobody else can replicate. The other thing, from the very genesis of all our strategies, we have captured data, voluminous data, longitudinally over the 25 years in all sorts of different ways. And so the power of the insight we can derive from that data relative to somebody who's newer to the space, it's just massively positively differentiated.
I do have to ask you about one of the other businesses under your, the Ridgepost umbrella, and that is on venture debt itself. That's totally different.
Absolutely.
I assume that's totally different than the lower middle market stuff.
It is lower middle market venture debt. debt, but it is venture debt.
Venture debt, but it's a different type of company, right?
Yeah, I would say so. Our venture debt, it's called WTI, Western Technology. It's our venture debt strategy. By the way, they were founded in 1980, so they have been at this an awfully long time. Again, focused on the durability of the franchise. But generally, we are not focused on what I would call the household names and technology that you're hearing every day.
But a lot of what WTI did back in the day invested in companies that are now household names.
They ended up being household names, but they didn't start there when they were doing the initial investment.
Is that harder? Is it harder to do something like that, where you are looking for the next Facebook or Google or whatever?
Look, I think the reality is they've been doing it a long time. They have a great network of relationships. They're a trusted partner to all the VCs. They offer an incredible kind of financing solution package to entrepreneurs, and people like to do business with them. And so they've been incredibly successful, and I think they continue to really grow and scale that business.
Just real quickly, only about a minute left, but I do want to go back to the competition thing, because I feel like in the middle market, it was kind of, you had a small group of players who kind of had the ball to themselves. You're seeing some of the big players come down now. You were at a big bank.
Trying to.
Yep. I mean, you're at Goldman for a gazillion years, and so I mean, you're aware of this.
100%.
Does it worry you at all, though, that maybe the Apollos and maybe not Goldman, but some of the others ones will finally sort of say, we really want a piece of this, and we're going to take it?
I'm sure they'd like a piece of it.
Yeah.
Respectfully, I think they're incredible at what they do.
Yeah.
I think we're really good at what we do too.
Yeah.
Those things are different things, and I think there's a difference between being a local and a tourist.
Yeah.
And I think we're going to remain as the locals in the middle and lower middle market, at the tourists, at the locals in the middle and lower middle market.
All right, Luke. Well, great to have you here.
Thank you so much. Really appreciate it.
Luke Sarsfield there, the CEO over at Ridgepost Capital. We'll be back in a moment. This is Bloomberg. All right, here on this Wednesday, we had a bit of a pullback from those record highs that we had on Tuesday, largely because of a bit of a drag from some of those big tech names coming out of some of those earnings that we had yesterday, including from AMD and SpaceX. We got some earnings after the bell tonight, and we're going to get some more tomorrow that could potentially move the market. In the morning, we do get Warner Brothers Discovery. There'll be a big focus there, particularly as to, the will they, won't they, when it comes to Paramount Skydance. We're also going to hear from Datadog, so a little bit more of an update of what's been going on in the tech space. And we're going to hear from Zoetis in the healthcare space. Well, healthcare, one of the best performing sectors that we had today. After the close, we're going to hear from Sweetgreen. Of course, a lot of focus right now on that Cyclospora outbreak and how it might be affecting foot traffic into the salad chain. We're also going to hear from Airbnb, DraftKings, Cloudflare, Twilio, as well as Microchip Technology and Akamai. That rounds out most of the earnings that we're going to be focused on, and we're going to then turn our attention to what's been going on with the macro. That drumbeat to Friday's job reports that continues on Thursday. We're going to get the Challenger job cut data in the morning, along with the weekly jobless claims, and we're also going to get a peek at wholesale inventories as well. And of course, there's still a big focus on space, a big milestone potentially. NASA astronauts are scheduled to conduct a spacewalk outside the International Space Station, the first of 3 planned for August, as of course NASA tries to prep for its next leg past the moon. And keep an eye on the world of politics. We had several primaries last night. We get another one tonight, this one coming from Tennessee, which could have some implications here for the full midterm elections, general elections that we have in November. Stick with us here. Joe Matthew, Kaylee Lyons are up at the top of the hour with a bit more of a breakdown of what's going on in the world of politics.